Okay? This is, if you remember, we were talking about. Okay, should I give you like a minute to get it out of your system? Because I still need a lot of talk. Okay. Now, we were talking about liabilities. Last time we stopped here where we were talking about long-term notes payable, and we learned how to calculate both interest expense and how to calculate the reduction in principal. The payment is always the same. What changes is the composition of, basically is the part of each component. Interest expense will be made up of two components, which are interest and so the payment, the monthly payment, or the semi-annual payment, or the annual payment of a long-term notes payable will be divided into two parts: interest and principal. It's the percentages or the part of each component that will change. As you can see, if you add this one and this one, it will always be the same. And the journal entry would be, this is when we actually record the actual signing of the mortgage. The company will receive cash, $500,000, and they will sign a note, a new liability, so we credit mortgage payable. When later on, the first payment is to be made, it will be interest expense. That's always the same thing. Interest expense will be the interest rate multiplied by the carrying value. Okay? Mortgage payable, that will be the part that is calculated by subtracting, as you can see here. This one, it's simply the rate, so this is the interest expense, it's the rate multiplied by the remaining balance in the principal. So this is the balance in the principal. Sorry, I said that the carrying balance in the principal. And then when we subtract interest expense from the payment, from the semi-annual payment, that will give us the reduction in principal. We subtract the reduction in principal from the balance in principal, that will give us the new balance in principal. Now this is the new balance in principal. This is where we will apply, this is what we will apply the interest rate. We will apply the interest rate to the new balance in principal. Okay? So interest expense will be principal. Sorry. Will be the principal minus reduction in principal. This is the new balance in principal. Okay? This is the reduction in principal. Anyways, now, presentation. How do companies present long-term liabilities? You have long-term liabilities, you list bonds, notes payable. Usually, you list the percentage, it is the due date. So you have the percentage, the due date, you have, for mortgage payable, you also have some kind of, basically, the notes terms. Okay? So this is 11% due in 2026 and secured by planned assets. So this is a mortgage, more or less, it's a mortgage because it's secured by assets. Okay? As you remember, the long-term liabilities that are maturing within a year, that are due within a year, will be actually listed under the current liability section. There are two ratios that creditors and investors and basically users of information look at in order to analyze the company's performance. One of them is debt to asset ratio. Now, debt to asset ratio is simply looking at how much debt you have compared to your to whatever assets you have. So it will be this is where you divide total liabilities by total assets. The idea here is to look to find, for example, for every dollar of liabilities of debt, how many dollars of total assets you have to cover them. So, for example, if you have here, in this case here, you have 79.7%. That means the liabilities, they are equivalent to almost 80% of your assets. The higher this ratio, the worse it is. The riskier the company is, because in this case they have higher debt. Okay? So, debt to asset ratio, it's looking at basically the percentage of your assets that would be equal to your liabilities. This will look at the company's ability to pay their debts. Okay? Debt to asset ratio has identified basically the company's ability to pay their debts times interest earned is to look at the company's ability to pay their interest that has their interest expense basically, to pay the interest that they are supposed to due to their loans and stuff like that. So in this case, you divide net income plus interest expense plus income tax expense. Okay? You divide that by interest expense. In this case, it will tell you how many times the company can pay their interest. So in this case, it's 6.71 times. And the higher the number, the higher the ability of the company to pay interest. So if you are going to invest in the company's bonds, you would like to know that the company can continue to pay their interest. We get to the amortization of bond discounts. Remember, we were talking last time. We were talking about unamortized premium and unamortized discount. This is where we will learn how to do that using the straight line method. Here we are using the straight line amortization method. We simply divide the discount or the premium by the number of interest payments. So, for example, we said that for bonds, how often is interest paid? You guys remember that? How often is interest paid with bonds? Yes, semi-annually, which is to meet twice a year. So if you have a bond for 10 years, the life of the bond is 10 years, how many payments, interest payments are expected? 20. So you divide, in this case, the bond discount or bond premium over those 20 payments. This will give you the amount of discount that is amortized. So how do you calculate it? Like Candlestick Inc. sold, this is the same example that we had last week. They sold $100,000 5-year, 10% bonds on January 1st, 2015 for $92,639. This means that it is a discount of $7,361. Okay? So this is equal to 100,000. Sorry, I don't know. I know. So, okay, so this is equal to 100 minus this amount. Okay? So, interest is payable on July 1st and January 1st. we have bond discount is 7,361. It has a 5-year life, so 10 interest payments. Okay? We divide bond discount by 10. In this case, it would be 736 for every payment. Now, interest that the company will pay, will actually pay, so the interest that is actually to be paid, this is the amount that the company will actually have to pay. Okay? This is 5,000. That's based on face value multiplied by interest rate multiplied by 6/12. Okay? This is based on the contractual interest rate and the face value. That's the amount of check that will be sent to bond owners. Now, the interest expense that the company will recognize and will record will also include the amortization of bond discount. So in this case, the discount amortization per payment is 736. You add that to 5,000, which is to the 5,000 in this case, which is the actual payment. The interest expense that the company will record with every interest payment will be 5,736. Okay? That's the amount that the company will report. 5,736. On the other hand, columns D and E. So the columns A, B, and C, they tell you, they give you the amount that will be used to make a journal entry. The journal entry will be to debit interest expense, and then you credit cash and discount. Okay? Now you subtract, every time you subtract the discount amortization from the unamortized discount. That will give you the remaining part of the new unamortized discount. You remember when we were talking about when the company actually retires a certain bond before maturity. When they buy back a bond before maturity, the problem used to give us, for example, that you have $10,000 or $8,000 of unamortized premium or of unamortized discount, right? This is how this is calculated, by subtracting the amortization of the discount from the balance and under unamortized discount. Okay? As you can see, the carrying value of the bond will start increasing. Okay? It will start increasing until at maturity, the carrying value of the bond will be equal to the face value of the bond. So this is why when the company retires bonds at maturity, it will be the same as the carrying value. Face value will be equal to carrying value. You guys have any questions about this? And just to let you know, Excel can do that very, very, very quickly. If you want to try it with Excel, I actually intend to upload a file, an Excel file, where you can simply drag the formula, and then you can see how fast it will complete the whole amortization table. Okay? Now, this is the journal entry. It will be interest expense, discount on bonds payable. This is the amortization amount, 736, and then you have cash. This is the actual amount paid. So the 5,000 is the amount that is actually paid. 736 is the amortization. Bond premium is the same thing. Now, however, it's the same concept. It's the other way around. Here, bond premium will be subtracted from the amount of interest that will be paid. It's not added. Because bond premiums, they decrease the cost of borrowing. So in this case, you have 5,000 minus the premium, which is 811. Okay? You subtract that, and this will give you the interest expense. The interest expense in this case is 4,189. It is the amount that will be paid minus the amortization of premium. Once again, we subtract the amortization of premium from the balance in from the unamortized premium. That will give us a new unamortized premium. Okay? And this is the new unamortized premium that will be added to face value. Now, as you can see, in this case, the carrying value will start high, and then it will start decreasing until it reaches face value at maturity. Once again, this is why the company, when they retire a bond at maturity, whether it was sold originally at premium or at a discount, it will always pay face value because of this amortization, because of the amortization of premium and of the discount. Okay, in this case, interest expense will be, so for the journal entry, interest expense will be debited 4,189, that's equal to 5,000 minus the amortization, and we have premium will also be debited. Remember that we are trying to decrease it, so it has to be debited. So we debit premium on bonds payable, the amortization amount, we credit cash 5,000. Cash will be credited 5,000, regardless of whether we are amortizing a discount or a premium. This is the amount of cash that is based, the amount of cash paid. It depends on the face value and the contractual interest rate. It has nothing to do with the premium or discount. That's the amount of cash paid. Do you have any questions about liabilities before we talk about investments? Okay. So for investments, we will talk about, in this case, we start talking about, not investment. We'll talk here about the company's stocks, about stockholders' equity. So we finished talking about assets, we finished talking about liabilities, now we'll talk about stockholders' equity. Okay? So stockholders' equity is made up of two parts usually. What are those two parts? Remember on the balance sheet, you have two parts. What are these two parts? Yes? So you have common stocks and retained earnings. So what's common stocks? This is, sorry, they are sold on the stock market, yes. Part of the ownership, the whole ownership is stockholders' equity. So ownership of in the company will be both common stock and retained earnings. Now, common stock is basically what the company receives from their investors. So this is capital that the investors put in the company, which is different from retained earnings, which is a part of net income. So one of them, retained earnings, is net income. It's the part of net income that the company decides to keep in business. Okay? That came from business operations. On the other hand, common stock, and in general this is paid in capital, those are investments made by shareholders. That's why legally they are not the same. One of them is investors investing. The other one comes from business operations. So it's the company that generated those money. One of them was given to the company, that's paid in capital. The other part, the company made that amount from their operations. Okay? Now, before we start talking about that, we need to talk about generally about companies and corporations. we touched on this topic before. So companies can be classified either by purpose or by, so by purpose. What do we mean by purpose? Yes. Well, they can be actually classified by industry as well, but here we're talking about the broader classification. But you are right. You have companies that are usually classified by industry as well.
Whether or not their main goal is to make money.
Exactly. So when we talk about classification by purpose, it simply means that are we talking about a company that is created, or a corporation that is created to make money, that's for-profit company, or not-for-profit companies, corporations. Okay? So whether you have to look at the entity and see whether it is made to generate revenue and in a way to make profits. The main objective of the company is to make profits. The other one would be not-for-profit. Okay? Like for example, educational institutes in general, those are not for profit. Okay? Red Cross, that's not for profit. The main objective, the main purpose is to provide some kind of service. On the other hand, for-profit are like the regular companies whose main objective is to make gains and profits. Okay? The other classification type is by ownership. Is it privately held company or publicly held company? Now, privately held company, it means that the owner, basically it doesn't, the company, this is to make it simpler, the company does not have their stocks on exchange markets. Publicly held companies are what we usually have, companies that have their stocks are sold in exchange markets. Okay? Any questions about that? So like for example, Facebook, until recently, until a few years ago, when they had their first IPO, what happened? It was a privately held company. They didn't have a stock traded or actively traded in the stock market. There are certain accounting firms. There are a lot of firms actually that are privately held. And that privately held, it doesn't mean that it's a small company. Usually companies, they start private, where the owners, they might have partners, etc. However, it's closely held, and until they feel that they are big enough to basically to start selling their stocks. Publicly traded companies are companies that are like Procter & Gamble, Siemens, all these, Apple, Google, all these companies who are traded in the stock markets. So those are the main two ways to classify those corporations. Okay? We talked about the difference, and here we're talking about the difference between proprietorships and partnerships and between corporations. You remember when we talked about that in the first couple of chapters, right? Definitely not. It's not that definitely we did not talk about them. We definitely talked about them, but you definitely do not remember that. Now, corporations, they have a couple of advantages over proprietorships and partnerships. Remember, partnerships are very similar to proprietorships, except that there is more than one owner. So for example, one of the advantages of corporations is that it is being a separate legal entity that can have contracts in its own name. It doesn't have to be with the name of one of the partners. You have limited liability of stockholders. If you remember, the liability of the owners of proprietorship or partnership, it extends beyond the resources of the company. So for example, if the company goes bankrupt, the bank will go after the partners who own that company. This is with proprietorship and partnership. On the other hand, corporations, the owners who are the shareholders and stockholders, their liability is limited to their investment in the company. So the worst thing that can happen is that they lose their investment. However, the banks, the creditors will not come after their personal assets. Okay? So let's look at those ones. Wait, this one. This one. We talk about also transferable ownership. With a partnership, if you want to sell your share of the company to someone else, you need to get the approval of the other partners. Usually this is like the exact terms are written in the partnership agreement. However, but generally speaking, you need to get their approval. Whereas if you buy stock, you do not need anyone's approval to sell it to someone else. So ownership rights are transferable without the need to get any approval or anything like that. It's much smoother, it's easier with corporations. And remember that the company is not involved when you sell your stocks to another investor. They don't care. The only reason why they keep track of the ownership is when they send dividends. They need to know where to send the payments when they declare and pay dividends. Other than that, who owns it? They don't care. They know that there are investors with a certain number. Ability to acquire capital. Companies, like corporations, they can issue stocks to raise funding. They can sell additional stocks to raise some financing if they need it, for example, to build a new plant or a new building. They can always do that. Again, continuous life. We talked about that one time. Continuous life is it's linked to the fact that ownership rights are transferable easily. With partnership, the company might be dissolved in the case of death of one of the partners. With a corporation that is publicly held and it is traded, the stock is traded in the stock market. So if one of the owners, one of the investors, one of the shareholders dies, it doesn't affect the company. As a result, the company will have a continuous life as long as it is financially performing well. It's not going bankrupt. So as long as it's not going bankrupt, the company will remain indefinite. Now, some of the disadvantages, we get now to disadvantages. Some of the disadvantages of corporations is that there's a separation between management and ownership. With partnerships, usually you have the partners who actually manage the company, right? With proprietorships, it's the same thing. It's the owner who keeps track of the company's management. With corporations, shareholders, they are separate from management. So for example, you as a shareholder, you do not have the right to buy inventory in the name of the company. Partnerships, usually, a partner has basically their actions are binding to the company. With corporations, there's a separation. That leads to certain problems. And that, for example, what if the manager's incentives, they do not align with the company's incentives, or the manager's goals do not align with the company's goals? What's the manager's goal? To make money for themselves. This is first, because they want to increase their compensation. In many cases, you have the CEO, for example, his or her compensation might be based on performance. They call it performance-based compensation. So the higher net income, the higher their compensation is. So their goal is to increase net income even if it were to hurt the company in the future. Remember we talked once about earnings management? This is when the company manager, for example, they try to boost the net income at the end of their sales revenue, for example, at the end of the year to boost the numbers, even though that might lead to extra losses or additional losses next year. So in this case, this is one of the disadvantages because they cannot closely look at what the investors and shareholders cannot closely look at what management is doing. Now we understand that the shareholders will elect board of directors. And the board of directors will have to it's one of their jobs to oversee the work of management, but it's not the same as in partnerships. Government regulations. Corporations are actually, they have to follow more regulations. Like for example, they have to follow the regulations of the SEC for filings. They have to report certain information. They have to prepare the financial statements in specific formats, and they have to report it quarterly and yearly. So all these additional regulations that they have to comply with. And with SOX, for example, Sarbanes-Oxley in 2002, it introduced additional compliance regulations. So that the company will have now to have additional and stricter internal controls. They have to maintain an adequate and efficient internal control system. We talked about that in chapter 7. And finally, we have additional taxes. This is what we call double taxation. Okay? With partnerships, every partner will pay taxes on their own net income. With corporations, because a corporation is a separate entity itself, as a separate entity, bless you, they will have to pay income tax. So the company will pay income tax, and later on, when they pay dividend, when they send dividend to their investors, investors will also have to pay taxes on that dividend as well. You see, the company as a whole will have to pay income tax. Okay? And then later on, they will send part of their profits to their investors in the form of dividends, right? The investors will receive that which has already been taxed before, right? It hasn't been taxed. They will receive part of it, and because this is, as far as investors are concerned, this is an additional revenue to them. Personal revenue. As a personal revenue, they will have to also pay tax on that one as well. This is what we mean by double taxation. Any questions? Okay, now we look at how, this one shows the organizational chart of corporations. You have the shareholders, those are the owners of the company. So what they do, they elect the board of directors. The board of directors will act on behalf of the shareholders to select management. So basically they hire a CEO, a CFO, etc. And they start and they oversee their work. Now with Sarbanes-Oxley, the board of directors are they are required now to keep an eye on management, and they have to basically, Sarbanes-Oxley introduced additional requirements that they need to actually look at the internal controls of the company, etc. Okay? So the board of directors, the chair and the board of directors, they hire executive officers of the company who will actually run the day-to-day business operations. So the people who will actually run the company, this is the team. Of course, this is just an example. Basically, there might be more people who are involved, but this is basically that it gives you the idea that this is the management team. The management team is the team that will actually run business operations on a daily basis. Okay? The board's role is an oversight role. They have to look at what management is doing. And then you have the CEO. They would start hiring the other managerial team. Think about it as a team. Each one will have his or her own jobs. So the controller is like the chief accounting officer. He keeps the controller would have to provide, would prepare the financial statements. Okay, make sure that financial accounting numbers are correct. They prepare financial statements. They make sure that they are complying with internal controls, etc. The treasurer is the one who actually keeps custody of assets, of the company's assets. Now, how is a company formed? A corporation formed? It all starts with a charter. This is given by the state. So the state would grant the applicant a charter. The charter would state basically the purpose of the company, the founders of the company. Okay? So, and then once it is incorporated, the company would create their own bylaws. Bylaws are their own internal regulations and policies and etc. Okay? Now, every company has to be incorporated in one state. Usually, companies would pick the state where the regulation and laws suits them best. It doesn't have to be where their main line of business is. Okay? Even if they do business in California, for example, but for example, New Jersey's laws are more favorable to them, they will incorporate in New Jersey. They will have to acquire a license for every state where they operate. So in every state the company operates, they will have to acquire a license. However, they are only incorporated in the state, in one state. Now, the charter and the bylaws also, they explain what the shareholders' rights are. So generally speaking, shareholders, they have the right to vote. They vote on certain, they vote on the election of boards. They vote on the issuance of, bonds, as you remember. Okay? They have the right to some of the company's earnings. This is dividends. They also have the right to keep the same share in the company. If the company decides to issue additional stocks, this is not always. This is if the company has preemptive rights. Nowadays, a lot of companies are removing this. However, if the company has preemptive rights, it means that the existing shareholders have the right to buy or to keep their share of the company. Let's say that they own 10% of the company. They have the right to buy stocks to keep enough from the newly issued stocks to keep their share 10% before it is actually sold, before the company actually sells those stocks to someone else. So this is what we mean by they have the right to keep their own share of the company. So if they own 10%, they have the right to keep that ownership. again, they have the right, they have a share in assets after paying all their debts. Remember, this is stockholders' equity is what? It's called also residual equity, right? What do we mean by that? This is after paying all the company's debts, shareholders have the right to the remaining assets. Okay? So they have a residual claim because if let's say that the company is being dissolved or the company is going bankrupt, after paying all their debts, whatever remains will be distributed to shareholders according to their ownership percentages. This is how stock certificate would look like. So in this case, for example, you would have the number of stocks, you have the name, you have the company, you have the class, you have type of stock. Because so far we have been talking about common stock, but in certain companies, this is when the company only has one type of stocks, it's common stock. In certain cases, companies might have preferred stocks as well, which we will talk about soon. Okay? So you have, usually they keep them pre-numbered, those certificates, just for accounting. Basically, it makes it easier to account for. You have the signature of the officials of the company's basically management, etc. Any questions so far? So far, this is more of general information than anything else. Now, so stock issue consideration. When a corporation decides to issue stocks, okay, they have to take into consideration several things. First of all, how many stocks are they going to authorize to issue? Remember, this is in a way similar to when the company issued bonds. What happened then? When the company issued bonds, they got from the board of directors the number when they got from the number of authorized bonds. However, we said that this does not mean that those authorized bonds will all be issued at once, right? Now, the state charter, it states the number of stocks, the number of shares that the company has the right to issue. Usually, this takes into consideration the current needs of the company as well as future needs. If the company issues all the authorized stocks, they will have to file for an amendment. Basically, they will have to file for additional, basically for permission, authorization from the state to change the charter so that they will increase the number of stocks authorized. Okay? So the company, before they issue stocks, they have to look at several things. So they look, for example, at the shares that they have, basically that they authorize. They have to look at whether, like how they are going to issue the stocks. There are different ways. They can issue stocks and sell them directly, and consequently they would actually, they would have the risk of not being able to sell all of them. In other cases, they do in a way similar to outsourcing or factoring, like we studied before. This is when they actually have a deal or an agreement with let's say, a bank or I don't know, say for example Goldman Sachs, where they actually sell those stocks on their behalf for a fee, for a specific fee. Okay? And of course, what is the stock? What's the value of the stock, or basically what's the stock price? Now, like we said, authorized stocks are, the number of authorized stocks is set in the charter. Okay? It's usually more than the stocks that are issued. They take into consideration future needs of the company. Now, you need to understand that getting this authorization of issuing stocks will not lead to an accounting entry. The company has not issued any stocks yet. They have not sold those stocks. The economic event has not happened yet. What happened is that they got the permission to issue stocks. It's when they actually issue stocks, this is when the company will have to record that transaction. So, issuance of stock, like I said, the companies can do that directly by selling stocks themselves, or they can do that indirectly by actually looking at the investment banking firm to do that on their behalf. When they actually decide on the price of the stock, how do they do that? They look at the industry. They look at similar companies. The financial performance and financial position of the company itself will have an effect. There's the economy in general. If there's a recession, that will affect the stock price. Otherwise, if it is too expensive, no one will buy it. You look at, for example, based on, remember that this is not a company that just started. Usually this is a company that has been in the market for a while, and then they decided to go public. So what happens is they look at, generally speaking, how much money every share will earn. This is earnings per share. So what is the expected earnings per share? All these factors affect the price of the stock at the time they issue their stock. Okay? Now, the company will sell their stocks based on, basically in stock markets, right? In exchange markets. The price of the stock, again, of the selling of the stock. This is after after it was initially released, after the IPO, after the stock has been issued. The company will look at. The company will not be involved directly, and they will not be involved basically when one investor sells it to the other. The price of the stock in the market depends on supply and demand. If investors, they find that company A is favorable, they will be willing to pay more to buy their stock. That will drive the stock price up. If the company has any issues, it will drive it down. Sometimes it's not just the supply, it's supply and demand also in this case. Sometimes it is also affected by general economic events like a recession. Or it could be something that happened with a company, like for example, the oil spill, when BP, British Petroleum, they had this incident with oil spill. A lot of people decided to sell their stocks in BP, and their stock price took a dive not because the company was not doing well financially, but because they did not like how the company basically they accused the company of disregarding the environment and and they affected basically the wildlife. And this is something that's actually increasingly getting more interest. It's called corporate social responsibility. This is basically how the company reacts to various social responsibilities that they have, like for example, preserving the environment, treating their community, etc. Okay? Some people might like the stock better or less. They might sell their stocks in the case of an event like that. Okay? Now we get to par and no par value stocks. In the old days, and not just in the old days, many states actually many states, they used to require the company to sell or to issue stocks at par value or above par value. Par value was the stock price that was basically mentioned in the charter. The idea was that this is a capital that the company does not have the right to withdraw to protect their creditors. So this amount could not go to, for example, this amount could not go to basically as a dividend, could not be paid as a dividend. Okay? The reason is that this is the amount, the minimum amount that the state would require a company to keep in order to protect their creditors. However, this amount for many companies has become more or less obsolete. Why is that? For example, Lowe's Corporation, they have a par value of 1 cent. But if you look at the stock, it's sold over $40. So this par value is, in a way, it's insignificant compared to the actual stock price. So the company is not going to issue a stock below 1 cent when the current market value of that stock is like $40 or $45. Okay? So nowadays, a lot of companies are being incorporated without a par value. It's getting more common, and you have, in those cases, the board of directors might decide to specify a stated value for that price. So what they do is, instead of having a par value, which was mentioned in which would be mentioned in the charter granted by the state, if the state does not specify par value, board of directors might assign a stated value for that one. It is treated in the same way, but this is stated by the board of directors. Okay? We will learn how, and there are actually certain stocks that have neither. In this case, everything will go to common stock. So let's see how we account for these. Before we do that, let's do this. Indicate whether each of the following statements is true or false. Similar to partners in a partnership, stockholders of the corporation have unlimited liability. It is relatively easy for a corporation to obtain capital through the issuance of stock. The separation of ownership and management is an advantage of the corporate form of business. Because this is an advantage or a disadvantage? It's a disadvantage. The journal entry to record the authorization of capital stock includes a credit to the appropriate capital stock account. So what? False. Remember, the authorization of capital stock will not have a journal entry. It's when the company actually issues the stock. All states require a par value per share for capital stock. Okay. Now we get to the two forms of the two sources of equity in a company. Remember, we talked about common stock and retained earnings. Common stock is paid-in capital. This is the capital or the investment made by those shareholders. Okay? This is paid-in capital. And generally speaking, you would have either common stock or preferred stock. Common stock is whatever is. The preferred stock, the main difference between preferred stock and common stock is that preferred stock they are preferred when dividend is declared and paid. So they have claim over that, over dividends and over the assets before common stock. Usually it's more expensive. This is the disadvantage of preferred stocks. They have more they have preferred dividends, however, they are more expensive. So those two will lead to paid-in capital. You remember that if anything is paid above par value, this is what we did last week, we had paid-in capital in excess of par value, right? So anything in excess of par value will be added to this account, which is paid-in capital in excess of par value. On the other hand, we also have retained earnings. This is the other source of equity. And remember, retained earnings is what? Retained earnings is the amount that the company, is the part of net income that the company decides to leave in the business, to retain in the business. Because net income, what do you do with net income? The company might decide to pay part of it as what? As dividend, right? So as dividend, the company might share part of the net income with their investors as dividend, and then the remaining part will be retained earnings. So if Delta Robotics has a balance of 800,000 in common stock and 130,000 in retained earnings at the end of its year, stockholders' equity section in the balance sheet will be as such. So you remember you have assets, liabilities, and stockholders' equity. The stockholders' equity section would include two parts: paid-in capital and retained earnings. So far, because we're only dealing with common stock, we did not include the whole section as paid-in capital. We simply used to include common stock, right? Now we know that there are other accounts under paid-in capital. So what does the company have? The company will have paid-in capital. Underneath it, you have common stock. And the company will also have retained earnings. The sum of the two will be the total stockholders' equity. This is the sum of the two. Any questions? So far, this is basically the same as what we discussed before. Now, this is to compare. This slide simply shows that it compares capital accounts between ownerships, partnership or proprietorship, and corporations. For proprietorship, it will be one capital account for the owner. If it is a partnership, it would be one capital account for every owner. So it would be owners one's capital. Then you have here the normal balance is, as usual, for equity, it is credit. It has normal credit balance. For companies, they have two. They have retained earnings, and we have retained earnings and common stock. Okay, so for corporations, it's separate between paid-in capital and retained earnings. You have to understand the difference. There are legal requirements for the separation of the two. Dividends, for example, cannot be basically. The company does not have the right to pay dividends from paid-in capital. They can only pay dividends from retained earnings, not from the capital. The capital is actually whatever investment were made. Company does not have the right to use that for dividends. Okay. So at the end of its first year of operation, Doral Corporation has 750,000 of common stock and net income of 122,000. We need to prepare the closing entry. Remember, do you remember when we had the closing entry to close net income to retained earnings at the end of the year? Do you guys remember that or no? How do we close net income? How we close net income to retained earnings? Yes, Imran.
It usually goes to income summary.
Income summary and retained earnings, right? So what do? We debit income summary and we credit retained earnings. This is how we close net income to retained earnings. This is the part that will go on the retained earnings section, retained earnings part of the stockholders' equity section on the balance sheet. The company also had common stock of 750,000. Now, the second part of the problem is to prepare the stockholders' equity. Again, whenever you need to prepare the stockholders' equity section of the balance sheet, you have two components: paid-in capital, retained earnings. What kind of stocks does the company have? They are telling us that they have common stock, right? They are not talking about any other type. So you have paid-in capital. Under that one, you would have common stock, 750,000. Do we have another one? You have, like, for example, paid-in capital in excess of par value. They didn't tell us about that, so this is the amount that will be paid-in capital. Then we have retained earnings. This is what we closed here, 122,000. Now, the total stockholders' equity will be the sum of those two. That's how you prepare it. You have net income, you close net income to retained earnings. Once you close net income to retained earnings, this amount will go on the balance sheet under retained earnings. Then you look at the paid-in capital. Paid-in capital we could have had, for example, preferred stocks as well. You list them. So you list all the investments made by basically by shareholders. It could be common stock, it could be preferred stock, could be paid-in capital in excess of par value. Any questions? Now we get to the point where we need to account for stock transactions. Again, why do we do that? The main thing is to separate the two sources of equity, okay, and to separate basically paid-in capital from retained earnings. So when we issue par value common stock, first we will start with common stocks. This is when the company issues common stock that have par value. So in this case, when the company issues stocks, what happens? Remember, this is when the company is selling stocks. If investor A is selling stocks to investor B, the company is not involved. The company will keep records of who's buying the stocks for dividend purposes, but they will not take internal entry of it. Now, when the company issues stock, they are basically selling that stock. So they will receive cash. How much? The amount that is the market price. This is the amount that they will receive in cash. This is how much they are selling it. So the shares are issued for $1 per share. How much cash is the company going to receive? Cash will be debited, 1,000. Common stock will be credited. Common stock will be credited if it is a par value common stock will be credited every time par value. So in this case, common stock will be credited 1,000. This is par value. Okay? What about B? Those 1,000 shares are issued for $5 per share. How much cash is the company receiving? 5,000. They are selling them for $5 per share. So the company will debit cash 5,000. How much are they going to credit common stock? 1,000. Again, this is again par value. This is market price. This 1,000 here is also market price. In A, it was simply, the market price was simply equal to the par value, market. What about the remaining part? The $4,000, they will be credited to paid-in capital in excess of par value. Do you understand that? So common stock, when the common stock has a par value, this is the value that the company is required to use to record common stock. Anything extra, it will go to paid-in capital in excess of par value. This is why sometimes this paid-in capital in excess of par value, sometimes they call it premium on stock. Basically, the investors, in order for them to be able to buy that share, they will have to pay a premium to buy it. That's the idea. Because if the share is for 1 cent and the stock is sold for, or even if it is for $1 and the stock is being sold for $40, what does that mean? That the investors are willing to pay $39 in excess as a premium to be owners of those stocks, right? Any questions about this? Okay. And then in this case, the company will list paid-in capital as another paid-in capital account. So paid-in capital in excess of par value for common stock, it will be another account under paid-in capital and will be added to stockholders' equity. Any questions? Now, if the company is issuing no par value, but the company is issuing no par common stock, but the common stock has a stated value, the stated value is actually treated in the same way as par value. The difference will be in the word. Okay? You replace par value by stated value. So you would have paid-in capital in excess of stated value. Now, for example, assume that instead of $1 value, par value stock, Hydro issues $5 stated value. It has no par value. It has a stated value of $5. Okay? It has $5 stated value, no par, and they are issuing 5,000 shares. How much cash is the company getting? Cash will be depending on the market. So cash will be debited 40,000. This is based on the market. Okay? Common stock will be credited at stated value. So in this case, it will be 25,000. This is stated value. The difference between the two is what? Paid-in capital in excess of stated value. It will be credited, the difference between the two, 50,000. Any questions? So here, as you try to understand the concept, it's very simple, right? So this is when the company issues no par common stock that has stated value. If the common stock had no par value, no stated value, the whole amount will be credited to common stock. So in this case, the full amount will be credited to common stock. There will be no paid-in excess because there is no stated value. There is no stated value nor a par value. Any questions? Okay, so we'll stop here and